All right, so interesting. So let's do part two of um our consolidated statement of financial position. So we're doing consolidation of financial statement of financial position. So last time I think I was on the purchase consideration. So in this video we continue with a question, so that we can then learn how to calculate, purchase consideration. All right. So let's get started. So that is the question that we have on the share exchange and the deferred consideration. So Kelmark Holdings Limited acquired 24 million one kwacha shares, which is 80% of the ordinary shares of Kelmark Farms Limited, by offering a share for share exchange of 2 shares for every 3 shares acquired in Kelmark Farms Limited, and a cash payment of 1 kwacha per share payable 3 years later. So Kelmark Holdings share have a nominal value of 1 kwacha and a current market value of 2 kwacha per share. The cost of capital is 10%, and a 1 kwacha receivable in 3 years can be taken at 75 ingwe. Calculate the cost of investment and show journal entries for the parent account. Show how the discount would be and won't. So basically, this question is on how we can calculate the purchase consideration. So you get to face such questions in a comprehensive exam question, all right? So this will come like a note to basically, help you understand how the transaction went, or it can come as just as a paragraph to then help you determine the transaction structure of this particular group. So in this case, we've got a parent. So the parent that we have is Kelmark Holdings, which acquired Kelmark Farms, right? So the acquisition here, or the transaction, was that they got 24 million shares. And these 24 million shares are the nominal value of 1 kwacha, all right? And they represent 80% of the ordinary shares of the subsidiary which they acquired. So by it representing 80%, then we know that Kelmark Holdings becomes the parent and Kelmark Farms becomes the subsidiary, right? Because they're having more than 50%. But now, the question has not given us the value that was transferred by Kelmark Farm to acquire by Kelmark Holdings to acquire Kelmark Farms. What it has given us is the details of the transaction. So it is from these details of the transaction that we must then derive the value. So we must calculate the value, and then from there I'll be able to determine what was the transaction cost and what should go to the investment account of the parent. All right, so what key thing to see here in this question, there are 2 transactions. There was a share for share exchange, and there's a deferred consideration. So on the share to share exchange, what we are told is that Kelmark Holdings transferred 2 shares for every 3 shares that they acquire in the subsidiary. So they transferred 2 shares for every 3 shares that they acquired. And then what is very key to note, again, when you're calculating, when you're dealing with such questions, is that you need to understand what the nominal value of the shares were, and you also need to understand what the market price of those shares are. The reason is simple, is you need to understand what portion relates to the equity shares or the ordinary shares, and what portion should then, be accounted for under the premium shares, right? So we need to understand that. And then the other thing is, for us to determine the cost, is we must understand what the market price was, because you don't sell your shares at your nominal value. Basically, shares are transferred at the market price of the parent, right? Because this was a share to share, so you're basing the value on the market share, on the market price of the shares of the parent to determine your transaction price. And then the other component is a deferred consideration. So in a deferred consideration is where Kelmark Holdings has accepted to transfer a consideration after 3 years. Okay, so they are going to transfer a consideration after 3 years. Then there's for the other thing that we need to understand is the fact that we are transferring consideration after 3 years, we are creating a liability. So that is a long-term liability. We create a non-current liability in our book as a parent, okay? Because we need to transfer that consideration to the owners of the previous owners of our new subsidiary. Then the other thing that is going to be created is a financing cost. Because look, if you decide to defer a consideration, you are basically deferring the benefits. So you're basically deferring your obligation in the future, right? So by deferring your obligation in the future, you are creating what is called a finance cost. Look, the owners of the new subsidiary that we are acquiring, the old owners or the previous owners, have given you a financing. They were supposed to receive cash, right? They were supposed to receive cash. But what they have done is they have said, okay, you can pay us in 3 years. So in actual sense, what is happening there is that you are creating a source of finance for yourself because that cash was supposed to be transferred, right? But now they have given you to say, okay, you can use the cash that you have for the next 3 years. After 3 years, you are going to pay us. So you've created a financing for yourself, a short-term finance, or rather a long-term finance for yourself. That is a source of capital, an internal generated capital. Okay. So now for that, you have to pay interest on that. Okay. So you have to pay a finance cost for that. All right. So every year you'll be unwinding. Every year you'll be unwinding that interest rate. Okay. Or that interest cost. The other thing is the fact that you're paying in future, you have what we call the cost, the time value of money. You understand what the time value of money is. A kwacha today is worth more than a kwacha tomorrow because of the movements in the market parameters, inflation, and all those things. So by transferring, you want to see what could be the present value of this amount in the future. What would be the present value today? So you discount the deferred consideration in the present terms. Okay. So that is what you're basically doing. So those are the key things that you need to then understand in this question. I hope you've taken note of the question. I think I've taken time to try and explain. Now let's dive into the solution for the question. Okay, let's dive into the solution for the question. Just give me a minute. Let me just pull my Excel. Let me pull my Excel. All right. All right, let me just pull my Excel so that we can then quickly answer the question. That we can quickly answer the question. Okay. All right, it's coming up, it's coming up, it's coming up. You can grab your pencil or your pen and take note of how you answer such a question. All right, so basically, I think you're able to see my screen. What I'll do is I'll close this side so that we have a big the bigger working space. And then what I'll do is I'll try and okay. All right, so that we try and do that, but I think let me bring back my menu. Okay, yeah, let me bring back my menu. Okay, let me show my ribbon always. All right. Okay, so what we need to do to calculate the consideration price there is number one. So let's start with the deferred consideration. So what I would do is I'm going to put I'm going to take out my zeros there. Okay. So I'll take out my zeros there to denote millions in kwacha. So the first one that we have is a deferred consideration, right? So we are calling this a deferred consideration. So for the deferred consideration, since it is deferred, what is very key to note here, we were told that we transferred how many? We transferred 24 million shares, all right? 24 million shares. And these 24 million shares have a nominal value of 1 kwacha, all right? So meaning the value of the shares is basically 24 million kwacha. So we are basically saying 24 million shares, we multiply by 1 kwacha, which is the nominal value, all right, which is the nominal value, and then I'm going to multiply by, since it is a deferred consideration, we were told to say the 1 kwacha, all right, the 1 kwacha in 3 years is or can be discounted to 75 ingwe. So what I would do then, I would discount that to 75 ingwe. All right, like that. So this is the same as saying 24 multiplied by 0.75. So meaning my deferred consideration is 18 million. All right. So this is my deferred consideration. So meaning this 18 million will be paid in 3 years' time. So we are going to pay the 18 million in 3 years' time. Okay. Then the other one that we have to deal with is the share for share exchange. So the share exchange. The share exchange. So for the share exchange, we were told again that we are transferring how many? 24 million shares. So how do you deal with that? You basically get your 24 million shares, you put them there, multiply by. What was the transaction? The transaction was 2 for 3, right? So the parent is transferring 2 to acquire 3 shares. So how we present that when we are answering, we say 2 over 3, then we close that. Multiply by, what is the value of the shares of the parent? The value of the shares of the parent, we were told in the question that it was 2 kwacha, all right? So always get the shares of the parent. So these shares are valued at 2 kwacha. All right, so meaning the transaction value on that particular day is then that multiplied by 2 over 3 by 2, which gives us 32 million kwacha. So 32 million kwacha is the share exchange. So I can then say the total consideration for this transaction, the total consideration is a summation of these two here. This is the total consideration. So to acquire the subsidiary, the parent spent that. The parent spent 50,000. So that is a consideration price there. I hope we are clear up to that level. But now the question asks us to say, okay, show the journal entries in the parent book, right? So we need to show the journal entries in the parents of the parent, right? So the parent. So pretty much that. So what we are going to do is we're going to debit the cost of investment, all right? Cost of investment for the parent. Okay, so even here, let me just take out my zeros for consistency's sake. Okay. The cost of investment there. So then we are saying The cost of investment, we know it's 50,000. All right, so it's 50,000 there. This is what we are going to debit the cost of investment. So this cost of investment is in the parent. And then we are going to credit. Where is the other entries going? So we are going to credit non-current liability. The non-current liability, how much are we going to pay? So remember, we have a deferred consideration of 18 million. So this 18 million is a long-term liability. So we credit. So we are remaining with 32 million there, which was the share for share exchange, right? So what we are going to do is out of that 32 million, because remember it was a share for share exchange. Remember our shares have got a nominal value of what? 1 kwacha. So we are going to say 16 million shares. 16 million shares at 1 kwacha. At 1 kwacha will go to our ordinary shares, right? So this is basically our ordinary share capital. Ordinary share capital, which will be then 16 million. And then our market, oh no, consistency, start. All right. And then remember our share premium, credit share premium, our share premium, well, our nominal value is 1 kwacha. Our market value is then 2 kwacha. So we've got a premium of how much? Of 1 kwacha on the shares. So share premium will be credited with the remaining, 16 million. So if you total 18 plus 16 plus 16, this will give you 32. All right. 18 plus 16 plus 16 will give you 50, because 16 plus 16 will give you 32 plus 18, you get your 50 there. So that is how you are going to, that is how you are going to do what? To post this transaction in the parent. All right. So now let's try and do something here. Where's my, oh, okay, my calculator is far. All right. All right. So basically that is how you calculate that is how you calculate your purchase consideration. All right. So with that said, now let's continue. Let's continue with our lecture on consolidation, right? So that we finish the other aspects that were remaining. All right, so now let's look at another aspect in the preparation of the consolidated statement of financial position, which is your intra-group transactions, So what are intra-group transactions? So we are saying, companies within the same group, we call them related parties, right? Transact with one another. So this leads to the following problems. So number one, your current accounts, that is your trade receivable and your trade payables are affected, right? Then you have issues to do with your loan accounts also. So your loan with one another. So your loan accounts are affected in such a way that the parent can lend to a subsidiary and the subsidiary can lend to a parent. And in turn, this results in finance costs, right? So it results in interests charged between the participants in the group. The other thing is you talk about dividends, where the parent or the subsidiary pays dividends to the parent. So at consolidation, the dividends to the parent are basically cancelled. The only dividends that you recognize are the dividends that the parent then pays to its owners, right? Then you've got the aspect of unrealized profits on the sale of inventory, where you find that the parent transfers goods or sells goods to a subsidiary. at a profit margin, right? At a profit. So what happens is these goods that are now in the subsidiary are sold to third parties. But at the end of the year, when you're preparing your books, you find that part of this stock, all right, part of this inventory or part of these goods are still in inventory, they are still in stock. So if they are still in stock, there's an aspect of unrealized profits on that stock that is remaining. So that aspect of unrealized profit should be cancelled at consolidation. So that is what we are talking about there. We're saying the unrealized profits on the sale of inventory. The same thing happened when a part in the group transfers a non-current asset. So if you transfer a non-current asset at a profit margin, you create some problems there. In that, you're going to create what we call unrealized profits on the sale. And then the other problem that you create is that the other party will be charged excess depreciation, right? So they'll be charged excess depreciation because what happens is this: if I bought this phone at say 10,000 kwacha, and then I've depreciated this phone for 2 years, right? Then in the second year, I decide to sell this phone to a subsidiary. So if I sell this phone to a subsidiary, say for argument's sake, I bought it at 10,000 and then I'm depreciating it. So I'm saying the useful life of this phone is say 5 years. So my depreciation charge in this case becomes 2,000 kwacha. Then in the second year, I would have depreciated this phone by 4,000 kwacha, meaning my carrying amount on this phone in my books is 6,000 kwacha. Then I decide to sell this phone to the subsidiary, right? If I sell this phone to a subsidiary at 8,000 kwacha, you know what I've done is I've created a profit for myself. Okay, I've created a profit for myself. So the profit that I've created for myself is a 2,000 kwacha on this phone because my carrying amount is 6,000 kwacha. By passing it on to the other person at 8,000 kwacha, there is 2,000 kwacha profit. But remember, this asset is owned by a member of the what? Of the group. They have not sold it, they are using it. So that profit that I charged on this phone is actually unrealized. Okay, it's unrealized profit such that it is within the group. I've just charged profit on the other part or on the other family of the group. Then the other thing that I've done is I've created excess depreciation. What that excess depreciation will done, it is going to reduce the profitability of the subsidiary because remember, depreciation is an expense and you must charge it as an expense to the what? To the P&L. So if that is the case, then I'm understating the profits of the subsidiary by charging that depreciation there. So what happens when you're consolidating is we must cancel this transaction to reverse these effects on the what? On the P&L. So that is what we are basically doing by consolidating. So this is what we need to deal with going forward. So intra-group transaction, and so we're now dealing with the current accounts. How do we deal with this at consolidation stage? So we are saying balances owed within the group must be cancelled on consolidation or at the consolidation date. So if goods or cash are in transit between the parent and the subsidiary, make the following entries to the accounts of the recipient. Okay, so if goods are in transit, so meaning someone is paying cash to someone, or there are some goods moving from one end to the other person. All right. So when you are consolidating, this is what you are going to do. You are going to debit cash with that amount that is moving out. So debit cash and credit receivable. So when you debit cash and credit receivable, you have cancelled that intra-group transaction. Okay. And then on the other side, okay, you are going to do what? You are going to debit inventory, take the inventory back to or your goods back to inventory, and then credit payables to cancel that. So that is what you are going to do. So those are the accounting entries that you must then pass. Debit cash and credit receivables, and then the debit inventory and credit payables. This will make more sense when you are looking at a question, all right? But at this point, if you did financial accounting, you should be able to have a picture in your head of what is happening. Intra-group transaction and realized profits. So now, after you've cancelled the transaction, you must then eliminate the unrealized profit portion on inventory and your fixed goods, right? your fixed asset. So we are saying profits made from trading within related parties are recognized in the individual company accounts. This is well, explanatory. It's self-explanatory. We are saying here that when you sell your business, when you do a sale, either to a parent or to a subsidiary, you are going to recognize the profits in your books. So, but in terms of the group as a whole, such profits are unrealized and must be eliminated from the consolidated what accounts. So what you are saying is, since you're a group, these profits are unrealized. I like using this example of a home, right? In a home, you've got a husband and a wife, all right? So you've got a husband and then you've got a wife here. And then let's take the assumption that the only source of income that you have is your employment. So the husband gets a salary and the wife gets a salary. Together, you are a group, all right? So together, you're a group, and whatever income that you earn, you put it together and you call that the household what? Household income. And then what happens is along the way, the husband lends money to the wife. No, let me take it like, because when your husband lends, it usually doesn't come back. So now let's take him, for instance, that the wife lends money to the husband, and then the wife charges 10% interest. So the wife will say, okay, I've charged interest, I'm going to make a profit on my lending, right? But if you think of it, there's no other income coming from elsewhere. The only income you have is husband, wife coming from employment. So when the other month end comes, the husband is going to get the money that he borrowed from his salary, right? And pay the wife with interest. And then the wife will get that money, and then you consolidate it and put it together. What have you done? In actual sense, the money is just within the family. There's no extra money coming. So there's no extra profit that has been generated. All right. So the best way to deal with that is just cancel that interest, cancel those transactions, and then just treat them as normal transactions. So that is what you're trading with yourself. So by trading with yourself, you don't basically earn anything. The only extra money that will come is the business that you do with the outside world, okay, the third parties. All right. So that is why we have to cancel these transactions. So remember in our introductory lecture, we said we have to do what? We have to cancel these transactions. Just give me a minute. Just a minute. Hello? Okay, all right. Okay, yeah. So you have to cancel that. So that's what we need to do. So now, how do we go about doing this? So we are saying unrealized profit may arise in inventory where companies may trade with each other. We explained that. Okay. So how do we do that? We must create I know what we call a PAP. I call it a PAP. That is provision for unrealized what? Profits must be created to remove this profit. How do you then do this? First, cancel the current accounts, right? So first cancel those transactions. And then where goods are still held by the related party, any unrealized profit must be cancelled. So where goods are still held by the related party, any unrealized profit must be cancelled. So you only cancel the unrealized profits on the goods that are still in inventory. Okay, so only cancel unrealized profits on the goods that are still in inventory. That is what you must do. How do you do that? Your inventory must be included at original cost to the group. So you're going to include inventory at the original cost to the group. The reason we cancel is because we are trading within the group. I think I've given that explanation. So how do we then determine what we should cancel in terms of unrealized profit? Number one step is you must determine the value of the closing inventory, included in the individual accounts that has been purchased from within the group. So determine the value first. Then you are going to be given a margin or a markup. Okay, so use a margin or a markup to calculate the profit. So the question will basically give you to say, okay, the group charges a margin, or the what charges a margin or a markup. So you are going to use a markup or a margin to determine the value of the what? Of the profit. Then make adjustments depending on what the seller is, on who the seller is. Sorry. So make adjustment depending on who the seller is. So if the parent is the seller, This is what you are going to do. If the parent is the seller, the profit element is included in the holding company's account and relates to the following entities. I mean to the following entries to the group. So if the parent is the seller, meaning the profit is already included in the retained earnings or in the consolidated accounts. So the profits are already in the accounts of the parents. So you must eliminate them. So how do you eliminate them? Remember, to reduce a profit, what do? You debit. So debit group retained earnings. This is at consolidation, right? So when you're consolidating, debit group retained earnings with the unrealized profit. So by debiting, you're saying you're going to less it. Okay, so you less. That working 5 that we did in the previous video, you're going to remove the profit there and then credit group inventory. So you're going to then credit group inventory. So you would have worked out that that transaction. If the subsidiary is the seller, if the subsidiary is the seller, then you're saying the profits is included in the subsidiary account. So these profits are already accounted for. So since they are already accounted for, you must then eliminate them. Debit subsidiary retained earnings. Where do you debit a subsidiary retained earnings? Working number 2, net asset list. You remember the net asset list. So you must less the unrealized profits, and you don't affect, it doesn't affect the acquisition retained earnings. It affects at the reporting date. So the retained earnings at the reporting dates are the ones that you are going to affect. So you are going to less from that particular column there to reduce, and then credit group inventory. So this is basically how you deal with unrealized profits. So let me also deal with unrealized profits on non-current assets, right? So if one group member sells a non-current asset to a related party within the group, adjustments must be made to create a situation that would have existed if the sale did not occur. So I explained how then this spans out and how unrealized profit comes about on a non-current asset, right? But now what you need to do is you must account it you must treat it in such a way that ask yourself, if this transaction did not occur, what would have been the effect on the group? That is the question you must ask yourself. If this transaction did not take place, what would have happened to the group? The answer is that there would have been no profit on the sale. There would be no profit. Depreciation would have been based on the original cost of the asset to the group. So there would have been no excess depreciation. You won't create another depreciation within the group. So if the transaction did not take place, there would have been no profit, there would have been no depreciation. Okay? There would have been no second depreciation, rather. But you would have based your depreciation based on the original cost of the asset. So these are the adjustments that you then have to make. Compare the carrying amount now with the carrying amount that would have been held at the transaction or the transfer not occurred. So it will be very helpful for you to create such a working where you say, okay, you've got with transfer, without transfer, and then you put the PAP adjustment. So the PAP adjustments there is just a provision for unrealized profit adjustment, such that when you get the carrying amount at the transfer date, then you are going to have the depreciation at the reporting date. Then you have the difference there. And then you with transfer column also have the same thing. And then you've got the adjustment there. All right. I'm going to deal with a question, the last question that we are going to do before I step out and close this session. So we are saying unrealized profit. So the net PAP. So the net profit, the net provision for unrealized profit amount should be deducted when adding across parent and sub non-current assets. So this is at consolidation. So when you're consolidating, the amount for unrealized profit must be deducted when adding across. Profits on transfer should be deducted from the reserve of the selling company. So if the selling company is a subsidiary, then you have to deduct from there from working number 2, which is the net asset list at the reporting date, right? And then if the seller is the parent, then you have to deduct to adjust the consolidated reserves or the group retained earnings in working number 5. All right. Excess depreciation, difference in depreciation charged against the buying company. Okay, so the buying company is the one that is receiving. So if I'm receiving, then I'm going to charge depreciation. So the excess depreciation or the difference in depreciation charged against the buying company should be added to reserves of the buying company. So you add back to reinstate that. So you add back the depreciation that you charged, depending on who is receiving. So if the receiving company was the sub, then working number 2 at the reporting date, add back depreciation. If the receiving company is the parent, in working number 5, group retained earnings, add back the excess depreciation to reinstate that position. Okay, let's look at a question that we are going to then close with. So unrealized profit on non-current assets. So we are saying Chongo PLC transferred an item of property, plant, and equipment to Jaden Limited, its subsidiary, for $6,000. So here we are establishing that Chongo PLC is the parent company which transferred a property of plant and equipment to Jaden Limited, who is the subsidiary, and the transfer price was $6,000 at the start of 2001. The parent originally, the plant originally costed Chongo PLC $10,000. So Chongo PLC, which is the parent company, bought this asset at $10,000. Originally bought it at $10,000 and had an original useful life of 5 years when purchased 3 years ago. So 3 years ago, the parent bought this asset at $10,000 and the useful life was what? Was 5 years, right? It's 5 years. Meaning our depreciation charge as a parent is $2,000, right? The useful life of the asset has not changed as the result of the transfer. So as a result of the transfer, the useful life still remains what? 5 years. The question is, what is the unrealized profit on the transaction at the end of the year of 2001? Okay, let's quickly answer this question. Let's quickly answer this question. All right, so I'm going to create another table there. So what I'm going to do this here is that I'm going to put with transfer, then without transfer, and then I'm going to have PAP, that is your provision for unrealized profit adjustment, right? All right. So this is what we're gonna do. Okay. I guess you're able to see what's happening here. All right, so what was the original cost? Okay, so let's put our kwachas there. Always important to put the currency to understand what we are dealing with. We deal with money as accountants. All right. Okay. Oh no, the question is actually saying dollar, right? So it's dollar. The question is saying dollar. All right. So we are told to say the original costs. So the question is, had the transaction not gone through, what would have been our cost? 10,000. 10,000, 10,000 there. All right. So now the next thing we need to do is we need to calculate depreciation. Depreciation on this plant. Okay, so we have to calculate depreciation. How do we calculate depreciation? Depreciation is basically the cost We're using straight line method, divide by number of years there. So the cost divided by number of years. So it was 10,000, right? So it was 10,000 divided by 5, which is giving me 2,000 kwacha, $2,000, right? So we've had this asset, we've depreciated it for 3 years. So it's basically $2,000 multiplied by 3 years. Okay. All right. So that will be my depreciation charge there. So my depreciation charge is basically going to be $6,000. So meaning my carrying amount had the transaction not gone through would be $4,000. This will be my carrying amount. So this will be my carrying amount of this asset. Okay, but now with the transfer, we are told to say with the transfer, this transfer now, this was transferred at 6,000. So they sold it at 6,000. What has happened here is you've created a profit. 6,000 is what you sold at. Your value in the book was that. So there's a profit of 2,000 kwacha. Okay, so there's a profit of 2,000 kwacha there. Okay, that's the profit that we have there. Then now let's calculate depreciation. Depreciation. So depreciation in this year would be, so remember our annual depreciation charge is 2,000. So had the transaction not gone through, would have charged depreciation. So meaning that minus that. So meaning my carrying amount would then be transaction adapted. If the transaction had not gone through, the carrying amount would be 2,000. So this depreciation charge, the question is, are we going to have the same depreciation charge here? No. Remember, the acquiring company is only going to use that asset for how many years? For 2 years. So it will be 6,000 divided by 2. Since the useful life did not change, it still remains 5 years. So meaning the buying company will just use it for 2 years. So now you've seen what has happened here. This has resulted in excess depreciation. The depreciation that the group is supposed to be charging is basically $2,000. But because of the sale, the subsidiary is going to be selling to be charging 3,000. This has resulted in what? Excess depreciation of how much? Excess depreciation of 1,000. Okay, of 1,000. So that is the excess depreciation that we must reverse. Okay, so this is the excess depreciation that we must do it. We must reverse. Okay, so if that is the case, then we are going to say our carrying amount here in this year is now that. Okay, so if that is the case, if I sum that, I'm going to have that adjustment there. All right, so I'm just remaining with 1,000 there. Okay, so that is what is supposed to be done. That is how you are supposed to work out this. So the profit for unrealized profit, I mean the profit or the unrealized profit is basically 2,000 kwacha, and this 2,000 kwacha must be eliminated. So we know how to eliminate this 2,000 kwacha. So that is how you deal with that question there. The next one that I need to just tackle is the mid-year acquisition. So if a parent acquires a subsidiary mid-year, the net assets at the date of acquisition must be calculated based on the net asset at the start of the sub's financial year, plus the profits up to the acquisition date. So when calculating this, assume the sub's profit after tax accrues evenly over time, right? And then the exception would be if there is an intra-group loan. So that marks the end of the consolidated statement of financial position in terms of the lecture or the notes part. So the next time that I come, the third video that we are going to have is we are going to answer a question on consolidation. So we are going to basically now start consolidating and put the principles that we've learned into practice. Thank you so much and have a very good day.